Good afternoon, ladies and gentlemen. I'm David Sung, president of Nicola Wealth. Typically, we would be presenting our fall strategic outlook in person at one of our signature events, enjoying the opportunity to get together with all of you and connecting socially outside of our offices. However, these are not typical times. This is the first time we are presenting our market outlook through a live Nicola Wealth virtual platform. Now, it's amazing to see such a great turnout registered for this webinar and for our strategic outlook. And on behalf of John and Rob and myself and the Nicola Wealth team, I want to thank you for attending this event and for engaging with us in this virtual fashion. Now, of course, we hope that your families, your colleagues, and of course, each of you are safe and well as we navigate this unprecedented crisis. Now, the purpose of today's event is to provide you with an update on the current developments shaping markets, industries, and the global economy. We will be offering some of our perspectives on how we see the current environment, the issues that are top of mind for financial markets, fiscal and monetary policy, our perspective on the long-term implications of the COVID-19 pandemic, and last, and certainly not least, yesterday's election non-results. We want to give you a sense of how we consider the different components of the financial markets, how they are operating right now, and some scenarios as we move forward from here. Now, we won't pretend to have all the answers, but at a time when there are huge amounts of information and data flowing, we hope that today's presentation can help you interpret that information and provide you with a framework for your own financial planning and decision making. Now, with that, let me take you through the lineup for today's webinar. We're going to start with Rob Edel, our Chief Investment Officer, who will talk you through his latest perspectives on the different scenarios that are playing out in the market and reflect on what clients should be looking for in terms of signs that the markets are healing. I'll then turn it over to my business partner, Nicola Wealth Chairman and CEO, John Nicola, who has kindly agreed to share some insight into how Nicola Wealth is addressing the opportunities on offer in the current market and his thinking about some of the longer term implications of this crisis. And finally, I get the opportunity to sit down with our special guest, backed by popular demand, Dr. Darrell Bricker, Chief Executive Officer at Ipsos Public Affairs. Now, we're excited to hear his unique take on this moment and the historic trends shaping today's economy and, of course, politics. And with that, let me hand it over to our Chief Investment Officer, Rob Edel. Rob, over to you.
Today, the agenda, I'm going to break the presentation up into two parts. The first part, outlook during the pandemic, and then optimistically, assuming we get through the pandemic, we're going to look at what the world looks like in the post-pandemic world. Now, we don't think there are going to be a lot of new trends started during the pandemic. We think what's happening is current trends have been accelerated. So when we look at the current during the pandemic, it's pretty customary to describe the recovery in terms of different letters. And of course, the most optimistic being the V-shaped recovery, where you have a sharp decline and an equally sharp recovery. I think that's maybe a bit optimistic. I think the Nike swoosh is maybe more what we can see in the market and the economy. Now, also there's a W-shaped recovery. So you have a second wave, a double dip recession, or even the dreaded VW recovery where you have a third wave. There's also the U and the L, and I put them sort of in the same category because they're sort of similar. You could say an L is just a U that you haven't seen the final recovery. It's a sharp decline and then a period of very stagnant growth and returns. I think there's another letter that a lot of people are now using, which is K-shaped recovery. So it's a V for some people, and it's an L or a U for others. So we see that sort of a difference for different people and different markets. So we look at the economy. The first one we see, this is GDP growth in the US. You very much see that V-shaped recovery. So we saw, first quarter, we saw GDP start to go down, a big decline in the second quarter, that's your down leg, and then, a 33% increase in the third quarter. Now, that's not a full recovery. You would have actually had, because you're coming off a lower base, you would have needed a 45% increase, but a very nice V-shaped recovery. But you have to dig a little deeper. I think that's an overly optimistic look at the economy. If we look at the job market, employment, you see a real difference. Now, some parts of the economy and the manufacturing and goods producing sectors, you see more of a Nike swoosh. You see a nice recovery. But in others, which is more of the service related, hospitality, leisure, really impacted from the lockdowns, you see more of a U-shaped recovery. Looking at the markets, we see the same sort of issue. On the broader market, this is showing the S&P 500, you see a very sharp V recovery. So the S&P has recovered all its losses in record time, only 126 days. But if you dig a little deeper, it's not so V-like. Now this is showing the S&P again, S&P 500, that dotted line is showing where you have recovered from the top of the market, you covered all your losses. S&P up until October 21st, up about 8%. But look what's really pulling that market higher. It's the growth names. This is the S&P Growth Index, up 23.5%, recovered its losses very quickly, a very sharp V. And even within that group, a smaller group of names, so it's Facebook, Alphabet, Apple, Microsoft, Google, they're really what's driving the market higher. If you took those 5 names, which are about now a quarter of the S&P 500 index, the S&P would only be up just over 1%. So it's a very narrow market. And in fact, when you look at the S&P equal weight, so rather than have it based on the size or the market cap of the company, every company is equally weighted in the index. The index hasn't recovered all its losses. It's down for the year. Even worse, value names, down 10% almost, down just over 9%. So there we see a real sort of L-shaped recovery. And if we look at the difference, take the difference between the value stocks and the growth stocks, and it's showing you that K-shaped recovery. We see it in the economy, we see it in the markets as well. Now let's look at the bond market. This is, I think, the best example of the L-shaped recovery, because you can see yields fell very quick and they're staying at very low levels. Now, that doesn't mean bonds have performed well. It means that yields have dropped. So actually prices have done very well, but there's not a lot of return in government bonds right anymore. In the corporate bond market, however, we see more of a type of a market that we saw in equities. So you can see on the upper part of that on the right, you can see Canadian and US investment grade debt. What I've done with this curve is I flipped it around because I want to show you that V-shaped recovery here. So when the line is going down, that means credit spreads are getting wider. So you can see during the worst of the pandemic, how yields were moving up, bond prices down, and now you've seen that recovery. So again, a very V-shaped recovery in investment grade. High yield bond, still very good, but not quite as good as what we saw in the investment grade. I'd say more of that Nike swoosh. You look at all of these markets, you have to say, and we're always amazed at how well the market has done. Why have the markets done so well given what we're seeing with the pandemic and different issues around the world? It's extraordinary, really. And we think there's 2 reasons that are driving the markets and the economy, and that is fiscal and monetary policy. Both have been extraordinary in helping the economy and the market through this trying time. Looking at fiscal policy in the US, you can see in 2020, US has spent over 3 different stimulus packages, $3 trillion. Compare that to what happened during the great financial crisis, 2009, 10, and 11. It dwarfs what was done in those markets. To dig a little deeper to see the actual impact, this is from the New York Times. It's making the point that if you look at the savings accounts of unemployed people, their savings have doubled versus people that are employed. And the reason for that is that UI benefits were, if you lost your job and you're on UI, you got an extra $600 a month. This meant that a lot of people were actually making more money unemployed than they were making when they were employed. And this money goes right into the economy. And so it helped a lot of people get through a very rough time. The unfortunate thing is that stimulus has run out. And now you're starting to see those savings rates decline. So it's been good up to this point, but if a new stimulus package isn't put through, then we could run into some problems. On the market, it's really been this wave of liquidity that the central banks, Bank of Canada, as well as the Federal Reserve, has been swept over the markets. And so what do we mean by that? Or actually, I'll show this graph on the impact first. You can see that this is the S&P 500. You can see how it bottomed out just after the Federal Reserve started cutting rates and as they started to expand their balance sheet and buy bonds. So that was, we think, the Federal Reserve is the real reason why the markets have been so strong. Looking a little bit more detail on what they've done, you can see that they've cut interest rates, overnight rates, to zero extremely quickly, more quickly than they did in past recessions. And they've also expanded their balance sheet a lot quicker. You can see this is a graph showing the Federal Reserve's balance sheet. You can see that jump during the great financial crisis, a lot more during this, during the pandemic. And what this means, what happens is the Federal Reserve is able to basically create money and use that to buy bonds and corporate credit. And that helps increase the price of those as people that sell those bonds have to go out and buy other assets. It's creating people to move up the risk curve, and it helps support the price of financial assets. So the real question, though, is how long are they going to have to do this? The Federal Reserve can do this all day long. They have a limitless balance sheet. Fiscal policy would be more of a concern, as we were hoping to get another stimulus package. That didn't happen before the election. And now with what's happening with the US election from last night, is a question of when we will get more fiscal stimulus. And so the key variable is really how long the pandemic will last. And the unfortunate thing is what we're seeing right now is Western Europe and North America. It's a question, as you see a second wave, whether we're going to go back down into a lockdown. And this, on the right, you see the red line is the infection rates in Europe, and you can see how that's moved up. And that's your classic, again, potential double dip recession in Europe. In North America and the US, actually, you see that first wave, second wave, third wave. That's your VW type recovery. So, what we need, obviously, is we need to get the herd immunity, and the best way to do that is a vaccine. So everyone's waiting for a vaccine. And on this front, we have good news and bad news. So on the bad news first, this is from Goldman Sachs, and using data from the Good Judgment Project. It's a super forecaster or aggregator of different forecasts. The timeline for which we can expect a vaccine enough to inoculate 25 million people, the timeline has slipped. So before we were hoping before the first quarter of 2021, now it's maybe second quarter, third quarter. So that's the bad news. The good news is that through Operation Warp Speed, President Trump Project Warp Speed, the US has done everything they can in order to speed up the process. And so one of the things they've done is they've pre-ordered millions of doses of vaccine from multiple platforms, enabling these companies to manufacture at risk before they are approved. So when they're finally approved, they can be distributed very quickly. The only negative with that is, you can see from this on the right, a Wall Street Journal NBC poll shows that most people are very wary of the vaccine, and are 80% are not in any hurry to take it. Now, again, this is a key, because while fiscal or monetary policy certainly can hang in there, fiscal policy is a question. How long can people's savings accounts hold out? And the longer the pandemic goes on, even with fiscal and monetary policy, you're going to start to see cracks form, for companies that are sort of fall through the cracks. And the concern is that some lasting damage to the economy will be done, and that you're going to be moving from a liquidity concern that can be dealt with by the Federal Reserve to more of a solvency concerns. So that's something we would worry about. I would say that if we don't, hopefully by the end of next summer, we would hope that you would get to a point where most social distancing measures can be eased. That would be the hope. If it's longer than that, then I don't think the markets are discounting that. But it's going to happen. We're going to get through the pandemic. So let's look at what the world will look like after the pandemic. And we said we think that the trends that were in place before the pandemic are going to be maintained. So, e-commerce, digitization, alternative energy. John's going to talk about these were all trends that we saw beforehand. We think they're going to be in place afterward through the pandemic. Two trends that I want to talk about today on a more macroeconomic level is GDP growth and inequality. And so GDP growth, you can see on the left here, since the great financial crisis has been very stagnant, around 2%, which is a sort of a more anemic level. and it's a problem. We would like to see stronger growth. The other thing is that it's also been, the slow growth that we've had has been unequal. There's been a growing divide between Wall Street and Main Street. So companies have done very well. The markets have done very well, certainly fed by low interest rates, but the average person is not doing as well. And so that growing divide is an issue. And the biggest issue around that, again, is monetary policy cannot do all the heavy lifting. There needs to be a transition to fiscal policy. And like we've seen during this pandemic, and we think that trend is going to be maintained. This chart from Jeffries sort of highlights that. It's showing the Federal Reserve asset or balance sheet growth, as well as the US fiscal deficit. So you can see during the Great Financial Crisis, they both moved up, but they weren't coordinated. So you saw the Fed first grow their balance sheet, and then you saw the deficit move higher, not more because of automatic stabilizers than anything targeted. Whereas if you see during the pandemic, it's been a coordinated move. And we think this is going to be the program going forward. And this is what we're going to see going forward, with more fiscal policy targeted to help deal with inequality. So how this is going to work is the US Treasury is going to issue bonds to finance the deficit. The Federal Reserve is going to stand by to buy that debt in order to keep interest rates low. So if you add a lot of debt, you can't have higher interest rates. It's not sustainable. So that's the key thing. It's got to be coordinated, that you have to have the central bank on your side. Now we say, this is limitless because, as we said, the Federal Reserve, their balance sheet is limitless and with no consequences. And we have a question mark because, of course, there's going to be consequences. So how will that play out? And this, a quote that I really like from Mark Twain, it says, "It ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so." And so for us, in thinking about this, the variable we always want to keep our eye on is inflation, because that has a dramatic impact on investment returns. And as you can see, this chart from Strategas, a poll of investors over the next 36 months, the average investor, according to Strategas, is also starting to think about inflation, not tomorrow, but over the next few years. Now, this is interesting because if you look at where inflation has been, it's barely got up to the Fed's 2% target level. The dark blue line is the PCE index, the Personal Consumption Expenditure Index. It's the inflation indicator that the Federal Reserve tends to key on. Again, barely ever gets up to that 2% target, and is well below that target right now, because overall the pandemic is a deflationary event. Now you do see that lighter line move higher, and what that is, it's the market's expectation of inflation based on the inflation protected notes, the break-even rates, but even they have not moved up towards 2%. You've had that V-shaped recovery. It's just back to where it was before the pandemic. The market's not expecting necessarily a higher inflation rate. And the biggest reason when you look at this, why you shouldn't expect inflation, is because there's a lot of spare capacity in the economy. And you can see from the Financial Times, this chart showing that we've over the next year, not only over the next year, but over the next few years, your US and Canada are expected to have excess spare capacity. So you can't have inflation if you have spare capacity in the economy. It's a supply-demand equation. Now, that's not to say there's no inflation anywhere, because as you can see from Goldman Sachs' chart, there's plenty of inflation in asset prices, again, in the markets. Financial inflation is very high. It's just you're not seeing it in the real economy. And actually, there is inflation in the real economy. You can see, stuff we don't want, yes, that's been going down in price. But again, stuff we like has been going higher. So there is some inflation, and we think with more fiscal policy over time, once you've used up that spare capacity within the next few years, you will start to see inflation move higher. Now, again, this isn't something we're expecting tomorrow, but it's something we need to start thinking about in our portfolios and start to position our portfolios accordingly. I like this quote from Warren Buffett saying, "Predicting rain doesn't count, building arcs does." So what is our arc? How are we going to protect our portfolios from inflation? And, you know, we think of diversification as the key attribute that you have to have in cash flow. And we like to try and follow the sort of the pension fund endowment model. So we want to have as many different asset classes as we can. And this is from Morgan Stanley Asset Management, showing what pension funds and endowments have been doing. And you can see fixed income and cash, the allocations has been coming down over the years. And this makes sense because interest rates are very low. So it's hard to see you're getting much of a future return. That and the fact that its diversification effects are diminished you know, with rates so low. Alternative assets have been moving higher, and we're going to talk a bit about that. But before I do, I'd also point out showing that public equities, the allocation to public equities, have also been going lower. Now, if you look at this from Goldman Sachs, if you look at valuations versus inflation rates, it's only when you go over about a 4% inflation rate that valuations start to come down. And again, we're well below 2%. Higher inflation is actually not a negative thing for equities. It's only when you get inflation to be too high. Now, as far as the alternative assets, again, John's going to talk about private equity and real estate, and, you know, which we think are also very good hedges against inflation. I want to talk about one alternative asset that is actually very well suited in an inflation environment, and that is gold. So this is a chart on the right shows gold versus real interest rates, meaning that when real interest rates move lower, gold tends to move higher. And that's, we think, is a key variable for gold is real interest rates. And why that is because nominal interest rates anchored at zero. When you increase inflation, which again, it's not so much that gold acts well with inflation, it's that as inflation increases, nominal interest rates, if you anchor nominal rates at zero, you increase inflation, real rates decline. In this kind of environment, this is good for borrowers, negative real interest rates, again, but it's bad for lenders, again, for fixed income investors. But positive for real assets like gold, like stocks, and real estate. Anyone that's able to have pricing power and increase their prices, you know, as inflation increases. So let's sum it up. You know, we talked about different letters. It's like an eye chart trying to find the different letters for the recovery. You know, we think you can see pretty clearly these letters, and which letter really prevails really depends on the vaccine, when we get a vaccine, and how much and how soon we can get fiscal policy relief. Ultimately, though, we think the key letters you would focus on is a V and a K. We think you do get a recovery, but the K is very important because we think that inequality is going to be what is going to be the driver for more fiscal policy, which should lead to higher inflation. And it's sort of that fiscal and monetary policy coordination, Wall Street versus Main Street, that you could create inflation that, even though we don't see it right now, we'd expect that to happen down the road, and we want to start positioning our portfolio accordingly. So with that, David, I'm gonna pass it back to you.
Thank you, Rob. That was a lot in a very short period of time, and it was great. You know, if I was to distill your presentation down to one key takeaway for me, I think it's that the legacy of the pandemic will be that it sped up current trends, as you said, rather than creating new ones. Now, Rob, the audience may have some questions for you, so we look forward to having you back on the Q&A following Darrell's presentation. We're going to keep things moving, so let's make a quick pivot, and I would now like to turn it over to my business partner and Nicola Wealth CEO, John Nicola. John, over to you.
Thanks, David, and good afternoon, everybody. I'm just going to switch gears as much as Rob did, and hopefully this lovely technology works. Okay. All right. So my agenda follows a lot of the topics that Rob covered, including the markets, the public versus private, the debate between either or both, a little bit of a drill down in terms of real estate, and in particularly the impact of COVID on it so far and what it might be as we go forward. New opportunities, and we believe there are many, especially in the area of sustainable innovation, renewable energy, transportation, And finally, some tax realities, which will make a difference to our Canadian listeners, because there's a very good chance that they are going to be going up. So let's take a look. The view of the markets is bifurcated. The Wall Street Journal, not too long ago said the market is crazy expensive, but that's perfectly okay, against David Rosenberg, who thinks we are in a massive bubble. So we want to examine where we might be. One of the things we can look at is the relative price of stocks. And right now, they are expensive. This is a chart of S&P price earnings ratio based on next year's earnings expectations. So they were taking a look at a year out's earnings. And currently, at the end of August, they were 26. Currently, they would be 26.5. The point is that that number is the same as it was at the height of the dot-com era, which was the highest the market has ever been, higher than the Depression years and higher than 2008. So there's nothing inexpensive about the way the markets are now from a US perspective, at least the S&P 500. And if we look at it from the economy's perspective, what you're looking at is a chart. If it's colored in blue or light blue, it means that that part of the economy is growing. If it's colored in brown or beige, it means that that part of the economy is either flat or declining. As you can see, most
John,
things...
I'm going to jump in for one quick second. There's not a lot that we can see at the moment. Can we try to see if we can share your slides one more time?
Yes.
There we go. It's coming up.
Better? Have we got that now?
Yeah, just need to run. There we go. All good.
Okay, so this is amazing. I mean, at some point in time, maybe by my 70th birthday, I'll actually have this stuff figured out. I was saying about the average U.S. stock being very expensive at around 26 times earnings, and this chart gives you an example of how expensive that is, and in particular, how much more expensive it is than it was in 2008. And also how the economy is doing in relation to, let's say, the pre-March period of time. So back then, if it was in blue, that part of the economy was growing. But since then, things in the brown and beige, things are getting worse in virtually every aspect of the economy, except for financial markets, which are getting better, significantly better, and having a very small, very quick decline in March. And this is what it looked like. As you well remember, the drop in March was huge. It was 32% virtually in a matter of weeks. As of the end of October, not the same date that Rob picked, the market had recovered 1.5%. Now we're talking the S&P 500. It's recovered 37% since then. And the question really is this the equivalent of what used to be called the Greenspan put back in the 90s, where essentially the Fed, by lowering interest rates, makes it virtually impossible to lose money in terms of buying assets, such as, in this case, stocks. And the concern that people like Rosenberg would have is, does that recovery represent effectively the dead cat bounce? Well, I was thinking that might be the case, because in the last 2 weeks of October, the market did in fact drop 8.1%. And the question was, okay, whether or not this was coming back to earth in terms of normal valuations. But somehow since then, it has managed to change dramatically in the other direction. And it reminded me of this quote from Isaac Newton, who at the time was potentially the smartest man on the planet. And he said, I can calculate the motion of heavenly bodies, but not the madness of people. And he was referring to the fact that 300 years ago this year, he lost 20,000 pounds, or about 4 million Canadian dollars in today's dollars, reinvesting in shares of the South Sea Trading Company. He'd already just literally walked away with a 7,000 pound profit 2 or 3 weeks before, putting all of it back in, losing all of that profit and another 20,000 pounds. And now what we have, of course, is the market is, since October 30th, and we're talking now 4 days, is up 7%. So there's a bit of insanity going on here. And the trouble is, Rob pointed out that the S&P 500 really isn't representative of the overall economy or even overall stocks. There are a lot of poor cousins out there, including the New York Stock Exchange itself, which is a much broader index. It's down 6% year to date. The TSX is down about same 6%. The London FTSE is down 22%. The Hang Seng 12%, and the Euro stocks almost 18%. So there's a lot of misery out there in terms of equities, and the S&P 500 and the NASDAQ are essentially the outliers. one of the other things that we see are people making projections. Now, these projections I'm about to show you were done by GMO, a very well-respected investment management firm in the US, and Morningstar, who manages data for equities and other asset classes all over the world. And this particular projection was done in March of this year when markets were much cheaper, and it predicts ahead of time, or tries to, what GMO thinks the returns are going to be in certain asset classes net of inflation. Normally stocks average 6.5%, but you can see here, they think US large equity stocks in the next 7 years would earn a 1.5% negative rate of return after inflation. Now you keep in mind, they did this when the market was 32% lower than it is today. And they think bonds are even in worse shape because of course they're starting from near zero rates of return. So traditional stocks and bonds, in their opinion, would be a tough way to make a return over the next 7 years. Morningstar, talking about their predictions for 10 years, and this was done at the end of last year, I think 1.7% year nominal returns, that's before inflation, for stocks, and 2.1% for bonds. And again, both of those were when the markets were more rational, especially the bond market was more rational. As you know, if you're a client of ours, we have a different asset allocation mix. Essentially, 50% of the assets we managed at the end of last year were publicly traded and 50% were private, including private debt, mortgages, equity, and real estate. And what we want our portfolios to do for our clients is all of them to generate effectively a rents, interest, and dividends, and that should add up to 3 or 4% annually of the total return, and therefore more or less make up 50% of the return over a business cycle. And that's pretty well exactly what's happened. Last year, cash flows averaged around 4% for most clients. Long-term returns have been around 7% over the last 20 years. So essentially, this is consistent in terms of cash flow being a significantly important part of the total return of any asset class. As Paul Drucker said, what gets measured gets managed. Now, if we take a look at what that has meant for the last 20 years, the average return for our clients net of fees has been 6.75% as of the end of last year since January 2000. If we'd been 100% in Canadian stocks, it would have been 5.46, US stocks 5.47 in Canadian dollars, global stocks 4.35, and if we'd taken the average balance 60-40 mutual fund, it would have been about 4.25%. So the difference of this approach has meant about $430,000 per million in terms of improved investment returns over the last 20 years. So that extra 2% a year is a material number. Let's talk a little bit about those private assets, private equity, private debt, and infrastructure, and see where they fit in and how their returns look. So for starting with private equity, when we compare it to public markets, for roughly, again, a 20-year period going from December 2000 to June 2019, a little less than 20 years, the S&P 500 returns were 6.7 and the smaller cap Russell 3007, but private equity had a weighted return of 9.1%, so a gap of about 2.5% a year more than public equity. So it has had a better track record over the past, and so this brings us to where we're going in the future. If you took a look at institutional investors, Rob talked about how we try to follow more of a pension plan institutional model for asset allocation. When it comes to private equity, 65% in private equity and 63% in real estate. This is the allocation percentage, not the number of institutions in allocating money to these categories. And on the individual side, the Tiger 21 asset allocation model, these are for people that have portfolios in excess of 10 million US dollars each. The mix between real estate and private equity is 50% of their total investable assets between these two categories. So let's talk about real estate. The fact is COVID obviously has had some impact on real estate. The question is what and where. So clearly, when you take a look at the impact on, you can see a number of things, highlights of the condo market in Toronto and taking a significant drop as a result of the fact that the demand for condos has dropped rapidly, and the amount of condos coming onto the marketplace as a result of people no longer being able to use them for Airbnb has changed dramatically. People are willing to walk away from deposits, and you're seeing a change in that market, while at the same time, detached homes are rising at very rapid rates in terms of prices and demand in both Vancouver and Toronto. So you have a bifurcated housing market just in Canada alone. In terms of the impact on COVID-19, it's very, very different for different aspects of the real estate market. So the question is the glass half full or half empty? So let's take a look at the office space, because people are saying that there'll be a massive change in the way that we work in the future as a result of COVID-19. This is a survey done by CBRE, a very large international real estate firm. And just take these 5 key takeaways. So first off, remote work looks and feels productive to most. The second, remote work is here to stay. The third, but the office is here to stay too. Real estate portfolios might look different, and there is no one size that fits all for remote policies in terms of the way people work. So I think at the end of the day, our view basically is we do not see this as the end of the office, but we certainly see it as the change in the office. And other aspects of the real estate market are going to be significantly impacted. Retail absolutely will have a huge impact, but it may also be adapting. Even now, you're seeing retail centers being converted into distribution centers for online shopping. So it's not really the death of the retail space, it's the change of the retail space into a different use. For the questions that we might ask ourselves in terms of our approach to investing in real estate include the following. So will North American population increase faster than in Europe or Asia? Will the overall economy be bigger? And I'm talking, let's talk 5 or 10 years out. What role will technology play in terms of how we learn, work, and buy? Will certain regions in North America grow faster than the overall growth of North America? How long will financing rates remain low? What percentage of my portfolio should be in investment grade real estate? What are my expectations of total returns in bonds, stocks, and real estate so I can put this into context? And so we look at all of these and then make some decisions about what we want to see for real estate. So the future factors for real estate as we see it include geographic diversification, a growing population, which quite frankly we see basically for North America, primarily driven by immigration. Residential is the safest, industrial is the next. Some retail will work, regional neighborhood malls with development and value add will make a difference. Build to own, especially residential, is a key focus for us. We see a lot of value being generated there. And finally, the spread between cap rates, that is the income rate on a building, and mortgage rates is critical. Right now, it is very, very attractive. We just refinanced an asset, an apartment building that we had completely redone in Victoria and received a CMHC financing on it at 1.2% for 5 years, when we first built it, we expected that mortgage to be 3.5%. So that makes a very big difference to the ultimate cash flow of assets today in real estate. When we take a look at the results for real estate, our Canadian Income Fund year to date is only up 2%, but over the last year, 8.2, 9.2 over 5, and 9.8 over 10. For US income, 6 for the year to date, 11.8 1 year, 5 years 11.9, and 10 years 11.2. And for the value add fund, this is a development fund, which has a higher degree of risk and lower liquidity than the other funds. The return year to date is 8.6 over 1 year, 13.9, 15.5 over 5 years. So, and the other thing is our real estate team has reported that since April, including from April through the end of October, our rent collection on our portfolio has been 97.6%. So we're very happy with those outcomes and results. Let me switch gears a little bit to energy. There's a lot of talk about we are hitting peak oil. BP itself, one of the largest oil producers in the world, has said that we will hit peak oil either soon or it may have already happened. And of course, this year, the demand for oil has dropped by about 10% so far this year, back to levels we haven't seen since 2013. Now, the question is, what's going to happen next? Well, that's anybody's guess. This is a bit of a complicated graph, but really what we're looking at is, this is what will happen if there's a rapid transition to renewable energy versus business as usual. If it's going to be business as usual, there's still going to be a decline in the demand for oil. It'll just happen more slowly. If it's rapid, the decline could be extraordinary, as in a drop of maybe 50 or 60% over the next 30 years. Now you have to remember, this is coming from essentially the oil industry. There's another group taking a look at this, and we'll come to them in just a second. When we look at renewable energy now, it's about 11% of the grid in the US, made primarily up of hydroelectric, wind, biofuels, wood, and only 9% solar. There are suggestions that's dramatically going to change because solar and wind are getting to the point now where they're not just cleaner than fossil fuels, they're now getting to be cheaper. The drop in the cost of solar photovoltaics has dropped 82% in 10 years. It's likely to drop by a minimum of the same amount in the next 10 years as well. And if you want to get some sense of how those numbers look, this is a great paper to read. It's free. So if you would like a copy, just let us know and we can send it on to you, or you can go to our website. We will post it there and you can download it from there. But it's by a group called Rethink. They did a great one on transportation before. And this is about, interestingly, renewable energy only as it relates to solar, wind, and battery cost. And so they're just combining these three areas. They're not including anything about hydroelectric or hydrogen or anything like that. We're just looking at these three factors. And they're saying that because of the way they're converging and reducing their cost, they see a 7 times increase in generating capacity in the next 10 years, such that effectively it could replace the entire fossil fuel grid for electrical generation in the US. And not just in the US. They're talking about this as being a massively disruptive technology. So 100% of the US electrical grid, not just in the US, but in most other developed countries, would have access to this same technology, not just cleaner, but cheaper, as mentioned before, but massively disruptive technology. The idea here isn't that this is somebody having to write trillions of dollars of checks in order to make people do something that don't want to actually do. It's more like the shift that occurred when we moved from a blockbuster in terms of watching movies to Netflix, and in terms of the way social and digital media work. Some of you may not realize that there was a time, I'm guessing, I think maybe 15 to 20 years ago, where Blockbuster had the opportunity to buy 100% of Netflix for $150 million and decided not to because it didn't fit its business model. Might have been a little different for Blockbuster if it had made a slightly different decision. Growth rates will be exponential in this space. So I think this is a very interesting area to take a look at. And whether Rethink is right, because they hope to be right, or whether it takes 10 or 20 years, the point is the rate of growth of this is going to be huge. Most countries, states, and provinces, I should say, are fossil fuel dependent. They are in a state where if they could have low-cost, clean energy tomorrow, they would take it in a heartbeat. And I think that's one of the reasons why how quickly this technology plays out comes down to cost. And if the cost drops as fast as Rethink thinks it will, then it's going to roll out much faster than most people expect. We have a sustainable innovation fund we created not that long ago, about a year ago, which is focused on renewable energy, clean technology, transportation, water infrastructure, et cetera. It has a comprehensive portfolio. I won't get into the detail here. Suffice to say that interestingly this year, while our Canadian equity pool is down still 10%, global is barely above even, US equity has done better. Again, coming back to this issue of technology stocks. Core Balanced has done reasonably well. That's the Balanced 6 portfolio we have with all asset classes. Sustainable Innovation is up 34.3% on a year-to-date basis. So it's really been unusual and outstanding so far. My belief is renewable energy and innovation will grow faster than the overall economy. That's the reason for making it a part of your equity portfolio, the publicly traded part. One of the questions I've been asked in other presentations done this year is people massively worried about how are we going to ever pay off all of this debt we're taking on as a result of COVID. And it got an interesting thing because I actually downloaded this analysis done by the Fraser Institute. And I realized I'm going to make an outrageous statement here, but what if it turns out that all throughout the developed world, nobody has paid off any debt that any government has ever accumulated on a net basis in 200 years? So in other words, essentially what happens is if you have a deficit of 2 or 3% of the economy every year, but in nominal terms, the economy grows at 4 or 5%, which historically is what it has done. It means the economy is growing faster than your debt, and you never actually pay the debt off. You see the space in the orange up there? This is the Fraser Institute looking at all of the debt and federal spending that has occurred in Canada since 1867, since Confederation, for 150 years to 2017. And if you see in World War I, 40%, the public debt charges, the interest on the debt, was 40% of the entire annual federal budget. In World War II, it went up again to 20%, but it didn't go up to 40%. And during the financial crisis of the 90s in Canada, it went up to 30%. By 2017, it dropped to 7%. As of now, it's less than 7% because of how low interest rates are. So the fact is that actually the level of debt we have now is really not a huge burden, especially today's interest rates. But more importantly, if you look at the way deficits work, you see that line that at zero, everything that's yellow under the line is a deficit. Everything above is a surplus. You can appreciate there's a lot more deficits than surpluses. So on a net basis, debt, when I say is rarely reduced, basically it is not reduced at all. So on a long-term basis, debt just rises, and essentially we have the economy, thankfully, has grown faster than that. If we take a look at the federal government's debt cost as it relates to the debt to GDP, you can see, in fact, it's dropped significantly. So there is actually room, and we will see an increase in debt to GDP in Canada. So I'm not that I don't worry about the level of debt, it's just that it may not be the crisis that people think it is. One area I do see happening is an increase in taxation. And rising taxes are not just a Canadian phenomena, we're going to see it likely around the world. Part of this is a perception, part of this is a reality, that there's a difference in wealth accumulation between those who have and those who do not have. It depends on the country you're looking at. In Canada, for example, the top 20% of the income earners are paying 56% of the taxes currently, 56% of income taxes, I should say. But the perception, I think, partially in the media and in other areas, is that the top 1% make as much as the bottom 99%. And there may be countries where that's true, but Canada is not one of them. So I took a look at the Canadian stats. The throne speech must blaze a new bold path, including imposing a wealth tax. So that's basically let's call it the federal government's position. On the right, you're looking at the Gini index. This is a World Bank estimate for the relative inequality of a country. And right at the very top, the higher the number, the more unequal the country is South Africa. And where do we stack up? Yeah, this chart is not big enough, so we have to cut out a piece. And we see that we're actually in 107th place, tied with Cyprus and Sierra Leone, of all countries. And that means we have less inequality than the US, China, Russia, Italy, Australia, Chile, Brazil, and Mexico. So the first thing you have to ask before you decide that you're going to generate a wealth tax is this: how unequal is wealth and income in Canada when all assets and benefits are counted? That question hasn't been answered either at the federal or the provincial level. So the things to take a look at, and I think we'll do this as a separate seminar, is in terms of tax planning for clients, keeping their income below that, where the maximum tax rates occur at $220,000 a year, income splitting better, learning for more effective ways for charitable giving, the use of flow-through shares, figuring out advanced structures in terms of incorporating, and finally, non-traditional portfolio design. And without getting into the details, I can tell you essentially that generally speaking, the asset pools that we put into taxable accounts attract far less tax than the returns they generate. So in most cases, more than 50% of the returns that they generate are not actually subject to tax. And so the design of your portfolio makes a difference in the tax that you pay. See, but you need to customize your approach. So coming back to our agenda, we talked about the fact that markets are expensive. Certainly public markets are expensive, but not all public markets. Public versus private, it's not a either or situation. We like the idea of the mix being in the 50-50 range. In the real estate area, basically, we have to find ways to add value in all aspects of the real estate that we're involved in. Otherwise, it'll be more and more difficult to get real good risk-adjusted rates of return. tax efficiency rates are very likely to rise. Planning should be done in anticipating that that's likely to be the new reality. And finally, there are going to be new opportunities in areas that will grow faster than the overall economy. And a sustainable innovation, I think, is definitely one of them. So I think we would certainly be recommending that for our clients. And with that, David, let me pass that back to you. I want to thank everybody for being here, and my apologies for getting off to a bit of a stilted start. So David, over to you.
Thank you, John, for your always insightful perspectives on the current investing environment and the considerations one needs to keep in mind when making strategic adjustments to their financial plan. Now, I'm sure there are going to be some questions from the audience for both you and Rob, so I'd like to take this opportunity again to remind everyone that you can submit questions through the Q&A function within Zoom, which for most of you watching is likely found on the bottom of your screen. Now, we've allowed time again for a moderated Q&A session at the back end of today's program. Because of a few technology glitches, we are running a few minutes late. So if you do need to exit the call a little bit early, please keep in mind that we do have today's session recorded and you can play it back on our website shortly. Now, a number of weeks ago, we had today's guest on another webinar we held. The ratings from that webinar were so good, and with the US election yesterday, we could not resist having him back. So today, it is my pleasure to welcome back prolific author and CEO of Ipsos Public Affairs, Dr. Darrell Bricker. Now, Dr. Bricker has published many academic articles and a number of best-selling books, including the most recent book of his called Next: Where to Live, What to Buy, and Who Will Lead Canada's Future. Now, if you've viewed our recent webinar with Darrell, you'll already know his profound knowledge of demographics, and considering the outcome of yesterday's US election, well, or non-outcome yet so far, I think we will be treated to a very valuable and compelling conversation with him today. However, before we begin with Darrell, Zoom webinar has a great polling feature built into it, and I'd like to poll all of you, our audience. So putting a financial context over yesterday's election, historically, do you believe the US stock market has performed better during Democratic presidents or during Republican presidents? Now, you should see the poll on your screen right now, but I'll repeat the question for everyone. Do you believe the US stock market has performed better during Democratic presidents or during Republican presidents? So take a few minutes, feel free to answer the question, but maybe as a hint or non-hint, conventional wisdom for Wall Street is that it might suggest that a pro-business Republicans being in charge would seem to be better for the stock market. So I'll leave you with a few more seconds to answer the poll. But with that, I'd like to, and as you're doing that, I'm going to welcome Dr. Bricker to the video screen.
Hey,
Darrell,
how are you doing?
I'm doing well, thank you. How are you doing?
Good, good here in the People's Republic of Toronto.
Well, thank you for being here. It's really great to have you back.
Thanks, David.
Darrell, as you probably heard, I've asked the viewers to complete a poll, and I'm going to put you on the spot. Curious to know how you answered the poll.
Oh, I think it's pretty clear. It's Democrats.
Democrats. Okay. Well, let's see what the audience has to say. If we can get the results up on the screen. Let's see. Well, just about 50-50, but it looks like a slight edge, 57% for the Democratic presidents. And for this poll, I'd say the audience got it slightly right, because as it turns out, dating back to 1927, the average excess market return under Democratic presidents is 10.7% per year, versus under Republican presidents, it's only minus 0.2% per year. Now that difference is almost 11%. And Darrell, as you know, that is statistically and economically significant. And it's well documented and referred to as the presidential puzzle. So while that's interesting and the subject of a number of position papers, let's let everyone ponder that one for a little while longer while I dive in, Darrell, for my first question for you today. Now, going back to the election itself, what do you think have been the key factors so far in this election? Has this election been, even though we don't have the results, a referendum on Donald Trump's populist agenda, or did the pandemic sideline that discussion?
It really is quite interesting when you look at both the exit poll and the exit polling that's been done on the election, plus interpret the results. It seems to be as much about, well, basically the election was about Donald Trump, whether you liked him or didn't like him as president of the United States. Sometimes there was substance associated with that. Sometimes it was just your reaction to his personality. But the thing is, the entire election was about him. He was able to animate his base better than the Democrats were able to animate their base, but everything was basically a reaction to him. You could almost see the Biden-Harris campaign as being like people riding in a sidecar. They really weren't affecting what was going on in the campaign that much. Everything was driven by Donald Trump.
The election appears to be much closer than the polls suggested that it would be. In fact, I think it was only maybe a couple of days ago that the polls were showing that Biden had a 10-point lead. It's about 50-50 right now from when I last looked at it. Any comments on that? Where do you think the polls, where might they have gone off again this time?
Well, there are often some specific ways, but not in a general way. So I think that the people who were careful about this knew that people who are careful about this and observe American politics more systematically know that the national polling results very often don't reflect what's happening in the actual race. Really what happens is, and as everybody probably knows on this call, it's really about winning electoral college votes through what happens at the state level rather than where the national election numbers are. Now, I said before they don't generally relate, but actually about 90% of the time they do. So the national vote is fairly similar to what happens in terms of the electoral college vote. But the last couple of elections in particular haven't really aligned in the way that they traditionally do. I can tell you from our polling position, our position always was built around what we called our central scenario. And our central scenario, which we thought was the greatest probability of the outcome, would be that it would be a very close election, probably to the benefit of Biden and Harris, but we also saw a path to election for Donald Trump. So and putting probabilities on it, about 50% possibility that it would be a close election benefiting Biden and Harris. If you add in what we saw as a close Trump election, that takes us up to about 70%. The other possibility was that there was going to be a Biden blowout, but quite frankly, we put a very low probability on that. And I know that what you're seeing in the election results right now suggests that it's 50-50. It's actually not if you've been tracking it today, it looks more like about 53-48 at the moment. And the gap will continue, well, actually not that high. It's about a 3-point gap. And that gap will continue to grow on behalf of the Democrats as they continue to count votes across the election. Our last poll had the Democrats ahead by about 7, so Biden and Harris ahead by about 7. I wouldn't be surprised if they come in somewhere around 5 or 6 ahead of Trump Pence in terms of the national vote. Was the polling off? It was off in some specific circumstances, like, for example, Florida. I don't think we've figured out a way to quite capture that Cuban animus that exists in Miami-Dade to the level that it needs to be represented in our election sample. So Florida was a bit of an issue, but by and large, if you know how to interpret the polls, and by the way, what you hear on television or what you hear from pundits or you hear on the radio is not necessarily a good interpretation of the polling. The polling's actually not that far off from what we're actually seeing in the outcome.
You seem pretty comfortable and confident with the outcome that I think your polling is suggesting. What impact, if any, do you think the mail-in ballots might have on the balance?
Yeah, so what we're seeing right now is that there's a real difference between how voting took place. If people were mailing in their votes, they tend to be quite a bit more favorable to Biden and Harris. And if they voted on election day, they're quite a bit more favorable to Trump Pence. And so what we've been seeing in the counts, if you've been following, and I've been up all night and I've been following this all day, what's been happening in the various counts, like say, for example, Pennsylvania, it gets closer and closer every hour. And the reason for that is because they're now, all of those mailed-in ballots are kicking in, and the ratio is usually about 65 to 35 in terms of how it works towards Biden and Harris. So what I expect is more of those votes come online. You're going to start seeing that gap is going to continue to grow in their favor. The only really big question that we have right now, and Pennsylvania was a much bigger issue, I think, prior to probably about noon today than it is right now. And really, that's because I don't know if people have been watching, but the New York Times and I think a couple of other players have now called Wisconsin on behalf of Joe Biden and Kamala Harris. So really, the only question is what's going to happen in Arizona, Nevada, and Michigan. All three places right now, in terms of the counting, have Biden ahead. Most of the ballots that remain to be counted are in denser municipalities or denser counties, which tend to benefit the Democrats. So as the time goes on, it seems like the probability of election for Biden and Harris, at least in terms of the White House, grows.
Okay, so if we go with your direction, which is Democrats win and Biden wins.
I'm still itchy though. I should tell you, I'm still very itchy. I mean, things can happen, but that's what seems to be the pattern. That seems to be the pattern right now.
Okay, well, if the pattern does play out that way, I remember in John's presentation, he referenced the potential for a fully sustainable driven US by 2030. Does Joe Biden have a green mandate?
No, it's very hard to see what kind of mandate Joe Biden has, because not a lot of what was going on in this election campaign had to do with anything that he was talking about. So, you know, every election campaign usually can be defined as a mandate or a message. This is more of a message. And it's really directed towards the Republicans and Trump and Pence than it is about an endorsement of what Joe Biden is committing to. Now, that doesn't mean that the more aggressive elements of the Democratic coalition won't believe that they've actually had an endorsement of what could be seen as a green type of a message, but those independents and particularly soft Republicans who moved in the other direction in this election campaign, that's not really what they were voting about. In fact, when we looked at what people were voting on in this election campaign, the environment doesn't rank probably within the top 8 issues.
Okay. Again, going with the theme of the Democrats, Biden would be entering the White House then with the U.S. struggling with social cohesion. Mm-hmm. How are the values of our country shifting over time? What are the factors that account for divergence in values, urban, rural, age, race, income? And what would be the implications of these just in terms of thinking about it from an investment perspective? Any thoughts on that?
Right. So what we're developing in Canada is this very similar to what we're seeing in the United States, where it's almost like city-states, where how people think in places like Toronto, Montreal, and Vancouver tends to be unique within the country. Although that's a really big part of the population, obviously. And you're seeing the same thing in the United States with how people feel on the coast versus how they're feeling in the flyover states. It's a different kind of a situation. And as urbanization continues to grow, you're going to continue to see that divide grow bigger and bigger. Both in Canada and the United States, the political systems actually don't benefit the downtowns and suburbs of cities as much as they probably should, as quickly as they should. It usually takes time for that to adjust. So what you see is rural and smaller town populations tend to have a bit more influence on the political system longer than their population would suggest that they should. But yeah, you're going to see a similar type of division in Canada to what you're seeing in the United States. Maybe not as extreme, but even if you look at the voting results from the last federal election, you see that pattern emerge. It's the downtowns versus the suburb. Downtowns and suburbs when they decide with the government versus small town and rural Canada and Western Canada.
You know, it does seem pretty polarized though in the U.S. Whoever wins, let's go again with the Democrats. How are they going to navigate the split amongst looking at the various different issues? So, for example, Ipsos Consumer Confidence finds that 48% of Americans want to reopen the economy, even if the virus is not fully contained, and half don't agree with that tactic.
Yeah, and that's one of the things that we're seeing. But people are divided to a certain extent on this question about how fast you should be reopening as a result of the coronavirus. But what I would say on the coronavirus issue is it's complicated. It's like politics. So, you know, how people feel about vaccinations, how they feel about re-engaging in the economy. even if they think that the economy should be open back up, are they personally prepared to go re-engage in the way that they were previously? And what we're seeing in the research is that there's a lot of work to do on that front. I don't know if I described this on the last call that I had, but I really look at it as a formula. And it's not the usual economic formula, which is, you know, supply and demand, price, you put it all together and you have a market. That's not how it's working around coronavirus. In fact, there are parts of the economy that are opening back up, but not a lot of people are re-engaging. And that's because the formula is really not related to supply and demand. People do want to re-engage, but they're afraid to do it. So it's really a new equation, which is supply, or actually desire, minus risk equals time. So to the degree to which people feel that they need to re-engage with something, subtracting the amount of risk that's associated with it equals the amount of time it's going to take them to get back to their previous lives. So those are the things that really politicians and I would say businesses are really having to work around. And I sometimes don't get the sense that they really quite understand how all of that works, but that's the formula we're all going to be working over the space of the next year at least.
Kind of continuing along this line then, Rob's presentation, he did show us a chart that suggested that 80% of respondents aren't in a hurry to be vaccinated. Mm-hmm. What would North American implications be, or North American expectations be about a longer term period under a pandemic protocol?
It's the same equation. It's desire minus risk equals time. So when you say to somebody's not in a hurry to get vaccinated, I'm not surprised. Because when people hear hurry, they think cutting corners, not safe, not been tested enough. I don't know what the side effects are going to be. I'm not clear enough in terms of the amount of risk that I'm going to be required to take. I'm leery to re-engage. So I think, you know, the question of vaccinations, people do see it as a panacea or a silver bullet. But the truth is, when you look at public opinion and how people are regarding or looking at these things and how their expectations are building around them, there's a lot of work to do in terms of setting the right conditions in order to make people feel that they can safely participate in a vaccine. It's not that they don't want to do it, it's that they fear doing it.
So let's take fear off the table. Let's take risk off the table. Everyone's comfortable, you know, it's proven vaccine, or, you know, everyone gets to that place. How likely are people to re-engage or revert back to an old normal? Or has the pandemic fundamentally shifted our lives post-pandemic?
Well, this is one thing, it's a really good question. This is one of those things where there's a lot of theories and too few data points. Because I hear a lot of theories about how the world is going to be changing after this. The truth is, we really just don't know. Are people really going to work from home, or are they going to get sick and tired of, you know, having their cat walk on their keyboard? We're not sure yet.
Not too long ago, I heard an economic theory that was referred to called revealed preference.
Okay.
Which is when you have two choices, the one that you are going to choose is the one that you're going to choose. In other words, pre-pandemic, you did have choice before, and you chose to be this way. Mm-hmm. During the pandemic, we have no choice. So if it's not there any longer, and if risk is off the table, do people just go back to doing things the way they did before? Or has this really truly opened up people's eyes to doing it a different way?
If that was the deal that you offered them, the vast majority of the public would revert back to that. And this is, and you can see a very good piece of evidence on this from the speech from the throne that the government brought to the House of Commons back in, I guess when it was October. Originally, it was all about build back better, you know, a line that they took from the Democrats. It was all about the great green new recovery, you know, a great opportunity, once in a generation opportunity to change things. And the reaction of the public was, you don't get that we're in the middle of fighting this thing. You don't get that we feel like we're really in a very difficult situation, and that we're very, very uncertain about what the future is going to look like, and we're very fearful about what the future is going to look like. We don't see this as the opportunity that you see it as. And in fact, government, you're coming off as you don't get it, and you're being at minimum cavalier. And through the course of September and October, you could see that the government figured this out, that the signals that were coming back to them suggested to them that the public wasn't prepared for an extremely ambitious program. They wanted something that was going to focus on fighting the pandemic, and they wanted, in particular, their prime minister engaged in the day-to-day fight, rather than standing back and saying, you know, this is the best opportunity we've had in a generation to change things. So you've seen them completely change tack. The reason that they did that was because they're looking at the same type of polling evidence that I'm looking at, showing that the public's not there. So maybe over time, they would move into a situation where they'll see the opportunities. But at the moment, that's not how they're feeling. They're feeling very much in jeopardy.
All right. I know we need to wrap up soon, so maybe one last question. The world's two largest economies have been front and center of the pandemic. How impactful has it been, is the US and China's response to the pandemic been?
Well, I think for the United States, obviously, even though the president has made them turn their eyes, outwards to try and blame other people, the real focus in terms of Americans right now is how their own governments are dealing with this, and that it came, how it got into the United States or whatever is not as big a debate for the public in general. They're really focused on the performance of the government. We know that it's the #1 issue as far as the public is concerned. It was one of the biggest issue in terms of how people were thinking about how they were going to vote in the election campaign. So it's very much an internal thing. China, the interesting thing that's happened with that is, even though there's a lot, I'm sure, happening internally, it's much more difficult to probe what's going on there. But what we do know, at least in the polling that we're doing, it's had a major impact on how the citizens of the world view China and its role in the world, and it's not been good. So the Chinese brand has taken a real hit as a result of what's happened due to coronavirus. What the implications of that are, I'm not entirely sure, but people are looking at China now in I would say a more negative light than they were a year ago.
Just to follow on to that, then, do you think that a Trump presidency or a Biden presidency will have what you just said play out more or less under each one of them?
Well, obviously Trump believes that there's something to be gained from focusing on an external enemy and really making this not about his leadership, but about something that was done to the United States by somebody else. So we've seen him, work that narrative for a while. Joe Biden has not been as active on this. He's been more focused on what the government has done or not done, and particularly under Donald Trump's leadership, in terms of fighting this disease. So his view on China and the international aspects of this is not as clear. Although I think that he's suggested that he may be more friendly towards, for example, the World Health Organization or international efforts to fight the coronavirus. But more clarity on that, I'm sure, is going to come over time. But right now, the Americans are focused on their own bun fight, which is their national election, and the next few days is really going to be about that, I think.
Okay, well, Darrell, you're a wealth of knowledge, and so I think this is probably a good time to hear from our audience, because I know a number of good questions have been coming in. So with that, let's invite John Nicola and Rob Edel back to the video stage. And just as they're popping up, a reminder to all of you that you are welcome to submit some questions through the Q&A function. Let's pull up the questions here, because I did see one come in that I think, Darrell, will be a great one to start for you. It is from Patrick Ryan. I have heard anecdotally that there is an emerging trend of people, especially those that can work remotely, moving from larger urban centers to smaller or rural communities. Now, Patrick, you did add on, how do you factor this shift into your real estate investments? I know you submitted that question before John presented his real estate slides. I think he covered that portion pretty extensively on what we're doing in the real estate funds. But Darrell, maybe you can take a shot at answering Patrick's question from a demographic standpoint.
I think that the interesting thing about COVID is not that it's really starting any new trends, but it may be accelerating trends that were already happening. So, for example, one of them could be this idea of people moving. But what we're more likely to see than people, say, for example, moving from downtown Toronto to, Deer Lake, in Newfoundland is probably what's going to happen is they're going to move into a place where they're more able to commute, and maybe not as regularly as they were before, but at some point during their work week, back to a place like Toronto. So probably what's going to happen is we're going to see some of the communities that are, and maybe we'll even extend the band a little bit bigger, commutable communities to our major centers, maybe seeing a little bit more activity in terms of interest in people working from there and moving from there. But they were already basically doing that because of the price of real estate. What I don't see happening anytime soon is those places like, say, for example, Timmins or Campbell River, or places in remote Saskatchewan, or remote New Brunswick or whatever, all of a sudden experiencing a huge revival because a whole group of knowledge workers have decided to move there and set up their careers. I mean, I could be wrong about that, but we've heard this same trope for probably 30 years. And we've seen some evidence of it happening around the outskirts, mainly driven by real estate prices, I would say, and maybe some lifestyle choices in places like the big cities. But I one of the big issues we're going to be dealing with over the next while is probably more of a move in the other direction. Older people moving out of those places and moving to places where they can have better access to healthcare and things like that. So I think it's a more complicated picture than just saying, as we're seeing in a lot of media reporting right now, hey, now's a great time to move to some remote place so you can, operate your bed and breakfast and also do your knowledge worker job. That's probably not going to happen to the same degree as some people are suggesting.
Okay, well, maybe a quick follow-on to that, Darrell and John. This might just be a one-word answer from you. Lola asks, so is real estate still good for investing?
Did you want Darrell to take a run at that one?
Well, I'll let you take, John, why don't you take a run at it? And Darrell, if you want to add on to that, please feel free.
Okay, so I mean, the problem with the question is real estate, still a good investment. The definition of real estate is absolutely massive. It would be fair to say that the global value of all private real estate and public real estate owned in REITs and things like that would probably be at least double the total value of all publicly traded stocks. So you're talking about a market so large that the term real estate doesn't actually mean anything. What you have to speak to is the nature of the real estate you're talking about. So on the one hand, you can make great cases for industrial real estate, specifically located likely in suburban or ex-urban areas in cities with good demographic growth. And if you can define it that way, then you can develop then a framework for real estate investing that makes a great deal of sense. So in terms of, if you're selective enough and you put the right filters on it, I can continue to see real estate being a very attractive investment per se, but there's no such thing as real estate being even an investment strategy, not that I would see.
John, Kevin Jeffrey asked, with real estate, rent collection of 97%. He's referencing what you presented. He asked, what was it pre-pandemic?
Yeah, that was, I noticed that question. I actually don't know, and we'll get Mark Hanna, who's our managing director, to get back to everybody and confirm the number. I'm almost certain, though, that it was not higher than 99%. So it's within 1 or 2 percentage points of its best outcome. I'm pretty sure of that.
Okay. We've got a question from our friend Rob Lucy. Rob, as only you could write, we are bored. Come the vaccine, do you buy the travel tourism sector, such as cruise lines, airlines, etc.? Rob, Edel, I think that's one for you.
Yeah, I mean, I think the question I think is also, do you buy it today, because they're really cheap? And what I would say is, you want to buy the companies that are going to make it to the finish line and not have issues and have to declare bankruptcy in the meantime. So strong companies, want to buy the leaders, and because I do think that there are going to be the cruise ships, that trend's not going to change. People were cruising before the pandemic, they're going to cruise after the pandemic. And what could happen is the weak players might be shaken out of the market, and you could have a lot of these stronger companies pick up a lot of market share. So yeah, I do think that that recovery could provide some interesting investment opportunities.
Rob, since you're fresh up here right now, we got a question coming in from Martin Davidson. Curious about your opinion of MMT, its likely imminent proliferation and long-term implications of it. And I'm assuming by MMT, he means modern monetary theory.
Yeah, no, and you know, in my presentation, it was alluding to that. I didn't call it MMT, but that's sort of where it goes. And what happens, and this is the issue, I think that it's going to be interesting to watch. I mean, it's one thing to start increasing deficits and increasing debt, and as John said, I mean, we're not going to pay it back. I think the real question becomes, how does it look for dialing it back, especially from a politician point of view. Politicians like to give, they don't like to take. It's hard to dial back that spending once you've started. And so I think that MMT, the idea of higher deficits, the only way it works is with printing money and keeping interest rates low. And this is sort of what John was talking about. And the way you grow your economy, your nominal economy, is with inflation. And that is the longer term implication. That was really sort of, you know, the point of what I was trying to bring out. You know, the central banks want inflation. It's how they are able to increase and deal with the debt, and that would be sort of the flip side of that. Now, what I will say, if you don't get that, if you don't get the monetary or the fiscal policy, and you don't see the inflation, you have a continued stagnating economy, you know, that's not a good result either. So it's choosing between two different, I would say, undesirable outcomes in that side of it.
Okay, thanks, Rob. A really good question coming in from Lawrence, which Darrell is right in your wheelhouse. What are your thoughts on the Canadian government's call to welcome over 1 million immigrants over the next 3 years? And what might the impact be on the economy and the electorate?
Well, it actually really links nicely to the MMT question. And the reason for that is because, you know, I'm a firm believer in that, and this is not going to be a controversial point, but there's no such thing as markets or governments or anything without people. I mean, they're really just a reflection of the realities of our population, our wants, our desires, and quite frankly, our structure. And the truth is that Canada without immigration is in a pretty difficult position. Statistics Canada, I don't know how closely you guys are monitoring this, but in the space of the last couple of months has announced some pretty shocking statistics about Canada. One of them is that for the first time in a long time, our population growth has shrunk below 1%. And the reason for that is because our immigration has been choked off as a result of COVID. If you look at our population growth over the space of the last generation, it's mostly been as a creation of immigration. It's we're not having enough kids to replace our population. By the way, also being crushed right now. Statistics Canada reported 3 weeks ago the lowest birth rate in Canadian history, as long as they've been tracking it. It's down to 1.47. And most of our growth, other than immigration, is coming from people aging, which, by the way, is not a great statement about our ability to remain productive in the future. So without immigration, we've got a lot of problems. But one of the other things that we know about immigration is large amounts of immigration create political instability. So as we've seen it in Western Europe, we've seen it certainly in the United States. So numbers are one thing, managing the influx of those people is another thing. So whether politically we're able to deal with this in an effective way and we don't end up in a type of populist type of revolt like we've seen in other places is something that I'm not really sure that our government is talking about or really thinking about that much. Because remember, when we say we bring in a lot of people and this is a big place and there's a lot of space for them to settle in, the truth is they don't. Over 90% of them settle in the 3 biggest cities that we have. So you're talking about a lot of change, and a lot of change makes people uncomfortable, and they tend to push back. And so I think it's the right thing to do. I think we need to be more honest about what type of change we're asking Canadians to accept, and I think we need to be prepared that there might be some sort of a political backlash to what's being suggested.
Okay, thank you, Darrell. I think we've got time for a couple of more questions, trying to stick with our schedule somewhat. John, I think this is a good one for you in light of the energy discussion you had in your presentation. In light of what you presented, does it make sense to continue or to twin the pipelines?
Well,
does twinning the pipelines make sense, and should we continue with it?
There have been a number of articles I've read about both that and Keystone, and making the point that, you know, if you take the emotion out of the argument, there are no pipelines that should be built that actually would make economic sense by the time they were completed, given the likely economic change or the likely technological change in the way energy is generated. One of the points I was trying to make about where sustainable energy is, and I was relating it to states and provinces as opposed to countries. The fact is that if you think about who gets to export fossil fuels and earn money from it, and who has to import fossil fuels and has to pay for it, you are talking about 90% of the world's countries, but you're also talking about 90% roughly of the US states and the Canadian provinces. In other words, every one of them has an incentive to say, if you give me the technology and I don't have to pay somebody else to bring in oil or gas or coal into my community, never mind the environmental impact. It simply is less expensive and more efficient, and I can generate it internally, then I'm going to do that. And so it strikes me that the pipelines themselves probably are an interesting political discussion. Economically, I would argue that they don't make sense, and it certainly won't make sense by the time they're actually completed. So it's not I'm not doing this on a moral basis, I'm doing it on an economic basis. I don't really see the logic behind pretty well any pipeline. And I think that's going to be, you know, it'll depend on how quickly technology gets implemented, but that's how I would imagine it will be.
Okay, thanks, John. I'm going to try to squeeze in two more here really quickly. This one comes from Michelle McAnulty. Michelle, thanks for asking this question. If inflation is likely to increase next year, should we consider large purchases such as vehicles or home improvements now? Rob, I think this is a good one for you.
Yeah, I mean, I think it's an extraordinary question from the point of view that we haven't had to worry about that for so many years. So I think my comment would be that depends on where you're getting the money to make the purchase. I think that from the investment markets can still do very well and above inflation, in which case taking money out of your investments to buy goods early, I'm not sure I'd do that. I never liked debt. I don't like debt, but you know, if governments and the financial system is going to give you free money, borrowing money in this environment, as I was saying, is very attractive at these levels. So that would make more sense, because I think again, you have real negative interest rates. It would make sense to take advantage of the low rates while we have it.
Can I just throw in a planning thing here related to this question? If one chose that one was okay taking on debt in order to acquire an asset, be it a house, be it a car, be it whatever, it would certainly make more sense to liquidate investment assets and pay cash for that particular asset. And if you were going to borrow it anyway, to then borrow and replace the capital in the investment account, because at least for by far the majority of our clients, that would make that loan deductible. And depending on what your tax rates are, might cut the cost of that loan in half. So it's a mechanical issue related to, is it better to have debt on, let's say, not on a non-deductible basis versus a deductible basis? And that changes the decision about whether the debt makes sense.
All right, I'm going to finish it up with this one last question from Donna Lee Langton. Donna, thanks for asking this question. What are your thoughts with respect to changes? Oh yeah, this one's discussed a lot. What are your thoughts with respect to changes in capital gains taxes on investments and primary residences? Darrell, do you have any? I mean, I'm sure you've heard this one brought up, over the last year and a bit. Do you have any thoughts on that question?
2 words: political suicide.
Yeah,
absolute political suicide. There is no government unless they win a huge majority and they're absolutely gun to their head forced to do something in the first year of their mandate that would really consider doing that. It is the ultimate middle class dream to own your own property. telling people, so many people who believe it's the single best investment that you can make, and by the way, large majorities of Canadians feel that way. Whether they're right or wrong, they're not that sophisticated, but that's what they think. If you tell them that you're going to be taxing them on that asset in a different way than you've taxed them in the past, I don't want to be running your campaign.
Yeah,
I think that's a good way for us to finish up. I want to thank our presenters, Dr. Bricker, John Nicola, Rob Edel. Thank you guys for sharing your perspectives. And on behalf of John, Rob, and myself, I want to thank all of you for joining this presentation today and being such great supporters of our firm. It's in moments like these that we really understand value and we cherish the relationships that we have with all of you. And we hope you found our fall event, in its virtual format, of course, valuable and thought-provoking. I hope everyone has a great week. Stay safe, everyone. And feel free to fill out the questionnaire if you would like to get a copy of Darrell's book. Thanks very much, everybody.
Thanks, everyone.
Thanks.
Bye-bye.